Hey everyone, it's Paul with your Tuesday YouTube video. I'm eyeing my disclaimer and ATG digital media plugs. But before I do any of that, let me tell you what this video is going to be about. So if you don't follow my podcast, I have a podcast that's called Bald Man Speculating. Yeah, it's on Spotify, and so check it out. And I also have a Substack, which I'll mention again when I plug ATG Digital Media. And in both of these places, I found myself this week writing about a certain subject. And in my opinion, this is incredible information, gold information that I believe that you should know. And it is something that no one is really talking about in the way that I'm talking about it. There have been people that are kind of like hinting around it, but I believe it's something even bigger than that, that absolutely matters for you, for your money, for your finances, for your investments. All right. Before we get going, though, a very fancy, high-tech disclaimer, which is that this YouTube video, the Bald Man Speculating podcast, my Substack, my X posts, all of the content on ATG Digital Media, model portfolios updates, trade recommendations are not investment advice. They are opinion, they are information, they are engagement, they are entertainment. Past performance does not equal future results. Errors, mistakes, oversights, yep, they happen. Capital loss is a likely and potential outcome that you should consider. I, the owners, contractors, employees, associates of ATG Digital Media, own, trade, and transact in the investments that are mentioned in all of our content, including this video and all of the videos that are on this channel. And speaking of ATG Digital Media, this is my company where we publish investment ideas, research, whatever you want to call it, information. You can check us out at atgdigital.media. We have paid subscriptions that begin at $9.99 per month. And what do you get for that? Well, you get innovation, growth focus, like laser focus. We don't look at things like oil stocks or old school bank stocks or old school moat investing, things like that. We focus on innovation and growth. Why? Because that's where we believe with conviction where the world is going. And that's where I have all of my money, and that's where all of our model portfolios are. So stocks and crypto in the innovation, growth, and also opportunity. What's opportunity? In other words, large new markets that may not necessarily be about something, that's high tech. We do stock picks, crypto picks, updates, market strategy, commentary. And if you want to check it out and see what does this sound like, what is it, what do they mean by this innovation growth focus? What is, our strategy, etc. Well, check out the Substack, which is 100% free. Many people charge for their Substacks. We do not. So you can go and sample us and check us out and see, like, hey, what is this dude? What is this ball man dude talking about? What is he talking about? All right. So to the subject at hand here. All right. So I started out doing this with my Bald Man Speculating podcast. The Bald Man Speculating podcast, by the way, is also for free. And then I ended up writing a very long X post as well about this. And then I took the X post and I turned it into a Substack. And now I'm turning all of those three things into a YouTube video. And in my opinion, this is going to be, I'm not being arrogant or you're a jerk here. I think it's like, going to be among the more important things that you will have found out, about interest rates, the economy, markets in a while, because it's a big, did I say big enough? Big shift, a 40, 50-year shift, something that essentially happens. Well, it's unless we start leading much longer lives, it's going to happen once in your lifetime. So what am I talking about? I'm talking about the interest rate cycle shifting. And we've not experienced this for like something like 41, 42 years, depending on when exactly you measure and how you want to count it. Let's just round it out to 40 years. And people may say, what are you talking about, Paul? Interest rate cycle. What does that mean? Well, if you study finances and you go and look, there is a long history. And this book actually goes back to, yeah, I mean, ancient interest rates. I mean, look at that. Rome. Yeah, I mean, they have interest rates, Rome. Well, there is a very well cataloged and well documented history of interest rates, sort of like rising and falling, rising and falling. And it happens over a 40 to 50 year time period, something in that range. You can't like exactly say 40 years. It's not like that kind of precision, but it's somewhere in that range of 40 to 50 years. And when it happens, it is well worth knowing that it is happening, because it changes sort of like the underlying conditions for assets, underlying conditions for what you can expect and how the world is going to unfold in different ways. So in my various pieces of content that I wrote, I've been citing the last interest rate up cycle. And we haven't had one since 1940 to 1980. So, I mean, most people have not experienced it. I would have only really experienced it mostly as a kid. And the vast majority of people would have almost no recollection of it. They probably didn't register because we didn't have the amount of financial media that we have today. We didn't have the internet. So, I mean, it would largely just been experienced as like, okay, this is happening. But in hindsight, now we have records that we can go to that are now much more detailed. Now I haven't gone back to Rome to come up with the content for this video, but I think it is worth looking back at the last upcycle, which begins approximately in 1940, and we have decent records and data for this. All right, and Dean, you can put up the chart, and what you want to focus on is on that left column. And the left column here is for 3-month treasury bills. And the reason why we want to focus on that is because 3-month treasury bills existed in 1940 and they still exist today. So this is a market rate that is consistent for the same period of time, issued by the US government. So there's a lot of consistency in this data. And so you can then kind of like make some judgments about what this is, etc. So if you go and look at this, and Dean, put this up and just let it sit for, let me count it out, 1, 2, 3 seconds. And for those of you watching this at home, you can sort of stop this video and go and look at it at another time. You can check out my Substack where there is a link to the document itself. But what you will see is that in 1940, interest rates were about zero, kind of like where they were in 2020 and 2021, and where they, were for the better part of 10, 12 years post the 2008 global financial crisis. And then we had, obviously, COVID happen, and interest rates were taken down to zero. And since then, we've had this very rapid rise. We have gone from zero, where we were still at the end of 2021, to where we are today, which is about 5.35% in terms of the 3-month treasury bill rate. The 10-year bond is now, about nearing 5%, the same thing for the 30-year bond. And all my references are to US treasury bonds that are sold by the US government, which is a global standard. And the reason it's a global standard is because worldwide people assume that the US government will not default on its debt, that it has taxing power, it has obviously the power to issue currency. And so default is not a outcome that most people would consider. And when you also look at the long-term track record of the US dollar, which, while terrible against a basket of commodities or many goods, is incredible versus all of the other fiat currencies of the world. So when you combine these three things, yeah, treasury debt is used as the standard to judge interest rates. But going back to my point, we have had an extraordinary rise happen between about 2020, 2021, and now. In other words, in about 2 years, if you go to the last time you would have seen an interest rate for the 3-month treasury bill begin with a zero, it's been less than 2 years since we went from 0 to about 5.5. That is an extraordinary rise, an incredible rise in interest rates. And it is quite, incredible and amazing and astonishing that after this, I mean, we are now 6 months into it, and I will put my hands up and say, I for sure would have imagined and thought that some part of our economy, all of our economy would weaken, be in a recession, and that the Federal Reserve would be forced to cut interest rates back to somewhere near zero again. But hey, that is not what has happened. Instead, the economy continues to grow. This morning, retail sales are up 0.7%. There is no real sign that there is a massive recession unfolding, that there is a grand crisis unfolding, that there is a catastrophic event that is unfolding. Yes, the internet is full of people saying this is going to happen and that is going to happen, but yet it hasn't happened. And when you look at the financial condition of companies, organizations, individuals, there is no smoking gun, if you will. There is no tipping point that is just waiting to be tipped. And yes, I'm sure people will come with all kinds of arguments, and I have seen a lot of the data. But in the end, markets are not that dumb. People don't like to lose money, especially in the debt markets, especially when they lend money. And so if there was a gigantic catastrophe that was unfold, 2 years, 5.5% worth of interest rates, yeah, we would have dominoes toppling over. Think back to 2008. I mean, we had Bear Stearns, Fannie Mae, Freddie Mac, Lehman Brothers, then the entire banking system, then Ponzi schemes like Madoff, all toppling over. Yeah, I mean, we should be seeing that. Instead, what we are seeing is we can see some clear signs that certain industries really are broken. They are dilapidated. I think that's the right way. They are obsolete, and they were clearly held up very long term by low interest rates. And it looks like they are going to begin a slow fade out, And that is going to be the impact of this rapid interest rate rise, which is that, yeah, it's going to have an effect, but it's going to happen over time. But I'm not going to go into all of that. Instead, I want to contrast what happened in 1940 to the 1980 upcycle. And in that interest rate upcycle, where interest rates were going up, interest rates were zero in 1940, and then they get to 5 and 3.4%, as you will have seen in that chart, it wasn't 2 years later. It wasn't in 1942. It wasn't even in 1943. It wasn't even in 1950. It wasn't even in 1960. It was 1968. 1968. In other words, what the Federal Reserve has done in under 2 years, that happened over 28 years in the last up interest rate cycle. And this is really the point of my video, which is, in other words, today, if you go and read commentators, strategists, gurus, people like me, guilty as charged, they will say interest rates are setting up to rocket higher and everything is going to collapse. And I actually believe that if you look at what we have just experienced and the last interest rate cycle, where it took 28 years, 28 years for interest rates to go from zero to where they are today, 5.35%, I make the judgment instead that what we are likely to see is a period of flat interest rates around current levels. So whatever, I mean, it's not going to be like, just a standstill. There's going to be some range which will form itself over time. Maybe it's between 4 and 6% for the 10-year bond. Maybe the top for the 30-day Treasury bill is going to be, I don't know, 5.8%. It's going to be some range, but it's going to sit there, and it is going to confound everyone. In other words, everyone looking back at the last down cycle, because what we have experienced from 1980 to 2021 is interest rates just going down. I mean, we go from that 14% at the peak all the way back to zero. So the high on interest rates is in like 1981, and the low is back in 2021, about 40 years. And everyone is just going to look and think like, well, it can, well, the next time there is going to be some kind of weakness, we're going to go back to zero. Instead, interest rates will, I don't know, maybe they get to 4%, something like that. And then when conditions are hot and inflation is running higher and economic growth is solid, people say, oh my goodness, we're going to go to 9 or 10%. Instead, we're just going to do this. Why? Because we have packed in 28 years worth of interest rate increases into 2 years. And I believe that under current conditions, this is something that can kind of like hold inflation in sort of place at probably between 2 and 4%, higher than what the Federal Reserve wants. So there's no incentive to cut. Yet the economy can grow at some modest pace, but probably, 2, 3, maybe 4%, maybe 5% in a very, very good year. And we're just going to have this condition last for 7 years, 10 years, maybe, 12 years, something like that. Again, it won't be a straight line, but in the end, if you focus on the numbers, let the narratives go, you'll just see it hang out. Now, can I prove that exactly this is going to happen? No. Still, interest rate cycle theory, you go through books like this, that's what it suggests is going to happen. So why does this matter? What does this matter for you? Well, in this new up cycle for interest rates, where long-term interest rates are going to make higher highs and higher lows. In other words, the next high is, whenever it comes, let's say, for assumption purposes, going to be like 10 or 12 years from now. Now, the T-bill rate might get to, I don't know, 8%. And then the next bottom out might be, 5.5 or 6%. So higher highs and a higher low. So in other words, that's what a rising trend represents. In that environment, what should you own? What should you own? Well, the thing is that is not like such a straight line. I believe for the next 5, 7, 10, 12 years, whatever that period of flatness is going to be, you can actually own a lot of companies that are quite similar to the ones that rose a great deal, I'd say like in that period right after 2008, 2009, a lot of growth companies that had real businesses that could generate growth rates well in excess of, 8, 10, 12%. Think Netflix in that era. I mean, that thing just rocketed up. Why? Because they had massive, incredible growth driven by their business rather than speculative demand for their stock. So this market is definitely going to be about business growth, about cash flows, about sustainable growth. In other words, you can't put your hand out to the market again and again and say, I need money, my business doesn't generate enough cash, I need more money. Yeah, those stocks, those investments, not going to do well. Not going to do well. You're going to have to show sustainable growth. You cannot put your hand out to the market and ask for money. Also, stocks that depend on purely speculative demand. In other words, there were a lot of stocks, a lot of investments, truthfully, that really pegged off low interest rates. Because if interest rates are low, you can borrow at very low rates and speculate. And if you made any amount of money, the spread between what you're borrowing and what you can potentially make is so large that it encourages an extraordinary amount of speculation. And you know what? There were a lot of stocks that were very speculative. And the demand for that is going to essentially be much, much, much smaller. Why? Because you can get 5% by putting your money into a bank account. You can get 5% by owning a bond. You can get 5% by owning a treasury bill. So people now have a price for risk that is significantly higher than what it was before. So what's the bottom line? Bottom line to this is that we're in a new era for interest rates. It is an upcycle. It's an upcycle. That's the quote unquote bad news, if you will. The good news is that we have packed in 28 years using the last upcycle as a model, 28 years worth of interest rate rises into two. So in the way I am seeing the world, that means that we can have, I would say at minimum, 5-7 years of stability where interest rates really don't go anywhere, and where there is a period where assets that can generate returns sustainably of 10, 12, 15%, they're going to outperform. If you don't need to borrow more money, these are and generate cash flow. Yeah, those kinds of stocks are going to outperform. And innovation and growth companies are absolutely perfect for it, with one qualification: they must have real sustainable growth businesses. In other words, if you are in a company with a kind of like a theoretical business model with a theoretical market that was completely subsidized by your investors giving you money, in other words, the only way you could really get people to use your product was to give it away for free, which means that when you went to charge for your product or service, your market disappeared. And with that, your business disappeared. Well, those kinds of companies are obviously going to struggle. But the vast majority of innovation and growth companies understand what is going on. They understand that the market has changed. There is no longer a market for just people throwing money at you. From here, you're going to have to generate growth and generate either free cash flow or profits or enough money to actually sustainably grow your company internally. So it is a new era, a new period. And I believe that even though it's been incredibly ugly with this last month or two, where so many small and mid-sized stocks have just been utterly crushed, I can say that if my interest rate call is right, in other words, we have packed in, I don't know, at least a decade's worth of interest rates, which gives us sort of like a period of stability. That means that investors are going to come back in and sort through all of the stocks like this one, sustainable growth. This one can grow 15%. This one, 30%. And they are going to come and bid these stocks higher. And I can tell you that there are very, very few legacy stocks. What are legacy stocks? Old school banks, these supposedly moat companies, etc., that can generate growth that is above 8 or 10 or 12%. So it's a very narrow world of largely innovation and growth stocks that can outperform in this environment because they meet the new hurdle rate of, I'll say, at minimum, sort of like 10%. And that's what our portfolios at ATG Digital, that's what we have, that's what we focus on. So companies that have invested in innovation when interest rates were low, they have built out their scale, their businesses, their business model. They have enough market, and now with legacy competitors are deeply weakened by higher interest rates, high labor costs because they don't have a digital platform. Our companies are digital. They don't use that much capital. So they are it's like a tailwind behind them, as long as they have a real market in business. And that's, the vast majority, I'd say, of the big growth companies that people focus on. I did my video last week on acronym called PUMPed, which is Palantir, Uber, MicroStrategy, PayPal, Exact Sciences, and 3D Systems. All these companies, they are real businesses underpinned by technology and innovation, and they have real markets. They can grow. So check out that video. And that's it for me this week. If you liked it, come back and just give me a minute here to get through all my books. Oh my goodness, I have a lot of books. I've been reading up this. You don't get to insights like this just by guessing. Oh yeah. All right. That's me saying bye.